Thank you.
Yeah. So, good evening to all of you. Today, we are very privileged to do a webinar on regulatory framework in insurance sector, and we have the privilege to have CMA Ramanna Aradunki sir, who is CGM of IRDA, whose presence adds immense value to this session. As a distinguished member of our institute and a senior official of the Insurance Regulatory and Development Authority of India, we are confident that his insights will guide us in expanding the professional footprints of cost and management accountants within the insurance sector. Before we start his formal introduction, we just have an auspicious note with our institute anthem in today's auspicious day of Karwa Chauth.
असतु मा सद्गमय तमसो मा ज्योतिर्गमय मृत्युर्मामृतं गमय असतो मा सद्गमय तमसो मा ज्योतिर्गमय मृत्युर्मामृतं गमय असतो मा सद्गमय तमसो मा ज्योतिर्गमय मृत्युर्मामृतं गमय.
Just to have a short profile of Ramanna Rao Adanki sir. Sir is a fellow member of our institute and also a company secretary associate member. He is also LLB, and just a short profile of sir is that he is currently working as chief general manager. He joined in the IRDA in 2011. Sir has worked as HOD with various departments at IRDA and has been instrumental in various functionaries like investment department, on-site inspections, surveyor, insurance marketing firms, F&A life, F&A non-life, legal, insurance, health and non-life department. Presently, he is handling general administration, accounts, and HR. He is also acting as educating officer of IRDA. Before joining the authority, Sir has worked with ICICI Securities from 2006 to 11 as Vice President Risk and Compliance and Merchant Banking Division. Prior to ICICI, he worked as Assistant General Manager at SEBI Securities and Exchange Board of India from 1997 till 2006. He was posted in various departments, including investigations, inspections, MIRSD, SMD, and depositories. He also worked with Container Corporation of India, NTPC, LIC, and Ministry of Power in various capacities. With this prolific profile, I welcome sir for today's webinar. Welcome to you, sir, and all is yours, sir.
So thank you very much, Divendra Raiji. I hope I'm audible, right?
Yes, sir, you're audible, sir.
Yeah. Thank you very much for my introduction, and thanks for the ICWA Institute for arranging this this particular session, so that I can actually meet my professional colleagues and I can give the updates relating to the insurance business. One is start a regulatory framework as well as the insurance business. So good evening, friends, and welcome to this session to all my professional colleagues. So I just would like to give some small presentation. And basically, you might be knowing that as per the BFSA is banking, financial services, and insurance. So banking and financial services, there are a lot of sessions will be there. A lot of people talk about that. But whereas as far as the insurance is concerned, though there is a very much important function of this BFSI, and the requirement will come to know when somebody asks you that we want to please take the insurance, then you will say that no. But when you want to have insurance, then companies don't want to take, don't want to give rather, because by that time probably the risk, mortality risk will increase. So at that point of time, you will realize that why I have not taken in the earlier itself. So that's the reason. I mean, the insurance is plays very vital part, and I would like to share one presentation. Please, please wait. Is it visible?
Yes, sir. Yes, sir.
Okay. Thank you very much, sir, for confirmation. So, I would like to cover this the total insurance business in India. We'll start with the regulatory framework, and after then the recent developments which are which have been taken place in insurance sector, because a lot of changes have been made in the last 2 to 3 years, and a lot of ease of doing business has been given the main emphasis and policy holder point of view, and the ease the many regulatory changes have been made. So let's start with the statutory and regulatory framework. So the key act for the insurance sector is Insurance Act 1938. So it is a pre-independence era, and the other act that covers many of the things that I will cover later, and IRDA Act, where IRDA has come into picture. So Insurance Regulatory and Development Authority, and where IRDA has formed, and the IRDA has become the regulator for the insurance sector. And we do have the other insurance acts, that is LIC Act 1956. Still this act continues, and many things with regard to LIC, because being the government is the owner of the LIC, so still some of the provisions are there from the point of view of the shareholder point of view. So many of you would have applied in the LIC in the recent past, and 3 years before when they came for the public issue. So that LIC Act has paved the way. And we have General Insurance Business Nationalized Act. This is actually the 4 public sectors were actually nationalized at that point of time, and GAC was also included in that. So all these public sectors, New India, National, United, and Oriental, were nationalized. And this earlier there were so many companies were there, and these 4 companies were formed. And later, of course, I mean, when the insurance sector got opened up, and new players started coming it, but still these 4 public sectors, as well as the GA, general insurer, GAC as reinsurer, are still there, covered under the General Insurance Business Nationalization Act 1972. And we have insurance rules, is 1939, which are again pre-independence era. Many of the rules are now lost its relevance, because in the Insurance Act, many of the things have been now the power has been given to the IRDA. So IRDA, many of those things are covered through the regulations issued. So now the insurance rules are very limited use. Some of the rules pertaining to surveyors still continue, and otherwise many of the things are now covered by the regulations. And we have regulations issued by the IRDA, and from time to time IRDA has been issuing the regulations. So in the last 2 years, in fact, 2024 was a very significant year. In fact, many of the regulations, almost 45 regulations, were brought down to 10 regulations, consolidating various regulations. It's a huge task was undertaken by the IRDA, and there was some regulation review committee was formed, and the committee where IRDA and as well as the industry experts were part of it. And after a lot of discussions, these regulations were summarized, and now more into the policyholder specific, more towards the instead of rule based, now it is principle based regulations have been formed. Apart from that, we have insurance core principles, being IRDA, being the member of IAAS, Insurance Association of International Association of Insurance Supervisors. This is headquartered at Switzerland, Basel, in fact. So IRDA is part of it, and the insurance core principles, which are around 25 core principles are there. And whatever regulations, whatever business, whatever framework that you are actually doing it, these core principles actually guide the framework, the regulation framework, policy making framework of IRDA. Some of the things like the ICPs, I covered that, like licensing of insurers or intermediaries, corporate governance pertaining to the insurers, risk management, how it happens, capital adequacy of the insurance companies, group-wide supervision if the companies are bigger and they have many subsidiaries, those type of things, and public disclosures. There are many things are there. So I am actually giving the just flavor of it. So what type of public disclosures they need to disclose. Incidentally, IRDA prescribed the insurance companies almost around 47 forms, so that they can anybody can understand what is the insurance, what is the financials of the company, how their grievances, what are the assets, what are the investments, what they made, what is the capital, actual reserves, everything is there. Are, if you see that the every company is mandated to put the public disclosures, and quarterly they do update. If anybody wants to see the company's profile company, that is the where you can actually make out the company, how it is performing. So that is also, you can see that any of the company, they're mandated, they can actually search in their, it is there in the landing page itself. You can click and you can see that the company related issues. So let's move to the preamble of IRDA Act. IRDA Act, if you talk, if you see that the authority established, the main purpose is to protect the interests of the policyholders, and regulate, promote, and ensure orderly growth. I mean, there is this, if you see that the task of IRDA is somehow challenging it, because it is the only financial regulator where the names of the regulation is there as well as the promotion. So, I mean, it's like, I mean, it's double-edged. When you are promoting it, probably the regulating is a very tough task. So that's, but the task has been given to the IRDA. So the regulation, promotion, and orderly growth of the insurance industry. So that is the main task which has been given to the IRDA, and accordingly it is established in 2000 pursuant to the Act of 1999. So let's move to the this IRDA Act. So IRDA Act, it came in 1999, and what we had just discussed about that protection of the policy interest of the policyholders, and the regulate, promote, and ensure orderly growth of the insurance industry. These are the main functions, main duties of the IRDA. So IRDA is a statutory body, and it is being headed by the chairman. And the recent chairman appointment was there. He had joined last month only, and Sri Ajay Seth, he is the present chairman. He was earlier secretary to the government, and he was heading the DFS, and before that he was heading the DEA. So and we have 5 full-time members, and these full-time members we have from different organizations. And with the different backgrounds, and we have 4 part-time members appointed by the Government of India. So these 5 full-time members, as per the Act, there are mandatory to have 1 full-time member from the life industry, 1 full-time member from the non-life industry, 1 full-time member from the actuarial. So another, the rest of the 2 are as per the government, I mean, a decision. And in fact, the members which are having the, I mean, the persons who are having knowledge about the finance, law, economics, administration, these are the some of the qualities which may be tested for appointing as full-time member with the authority. And 4 part-time members are there, and normally 1 person is the joint secretary or secretary to the government from DFS. It comes under DFS. So he is the person who is I mean, in our board, authority board. And we also have this Chartered Accountants Institute president. It's he's also on our board. I mean, it is that is also in our board. Insurance Advisory Council, as per the our regulations are concerned, IRDA Act also specified Insurance Advisory Council. So they advise us in framing the regulations. The IAC has a representation from the insurance companies, in the intermediaries, including brokers, surveyors, and even eminent personalities. There are more than 20 people are there who are actually these names have been notified, Insurance Advisory Council, and this council meets whenever the regulations amendments takes place. So the one moment. I'm sorry. So insurance, they advise us while framing the regulation. This is one of the unique in the insurance sector. It is not there in as far as the SEBI is concerned, as far the RBI is concerned, where there is a statutory council who advises on the framing regulations. But it is a very unique to insurance sector. And there are certain returns. I mean, being a statutory organization, the whatever the development that we have taken place, what is the how much insurance business can promoted, that we need to submit to within 9 months from the end of the financial year, and then those our annual reports are laid in front of the parliament, and even our financial reports are also laid in front of the parliament. Hope it is visible. Hello.
Yeah.
Yeah. Okay. Fine. Thank you. So IRDA, the duties, powers, and functions of IRDA. Again, the first one duty is regulate, promote, and ensure orderly growth of insurance business. And we have the functions like policyholder, this assignment, nomination, settlement of claims, and other terms of the contract. Those are also they are under the IRDA. Registration of insurers and intermediaries, prescribing qualifications, prescribing qualification, practical training, and prescribing the code of conduct to intermediaries. And of course, promoting efficiency in the insurance business. Many of the sectors covered under this promotion of efficiency in the insurance business. And the professional organizations, promotion, and this is ISLA is something which is the organization which is being promoted by IRDA. And there are levying fees on insurance intermediate, because that's how actually we IRDA gets fee income. And we also have the power to inspect and investigate insurers and intermediaries, and we have power to regulate the rates of the insurance sector. And in fact, I will come. Basically, there is earlier tariff advisory committee is there. Tariff advisory committee, it actually regulated the rates, and it is called tariff. So the tariff, all the companies have to give their insurance products at the defined rates by the tariff, tariff advisory committee. So they do the actual calculation. They tell that this is the rate we need to charge. Accordingly, all insurance companies used to charge. But this and the terms and conditions are also have to be governed by the tariff, which is given by the tariff tariff advisory committee. So there, what happened in 2006?
Sir, your slides are not moving, sir.
Yeah, correct. I mean, I am here only.
Yeah. No, sir, your slides are not presented, sir. If you can share that.
Oh, okay. Is it visible now?
Yes. You can continue, sir.
Yeah, I am on the duties, powers, and functions of IRDA. So this tariff was de-tariffed in 2006. Since then, the insurance companies can issue policies as per their own claim experience, their actual rates, whatever assumptions what they are having it. But the terms and conditions were the same till 2024. 2024, the de-tariffing of terms and conditions all being done. So now the policies all will not be alike. I mean, whether you talk about fire, marine, even whatever these type of things are there, no? So you will not get the policies same, even motor. So now there could be terms and conditions will be changed by the insurance companies as per the requirements of the dynamic requirements of the market. So returns and the books of account of insurance intermediary, these are the things, so that I mean we'll monitor and we'll understand how insurance and intermediaries are functioning. Investment funds of the insurance companies, we do have almost 70 lakh crore investments by the insurance companies, and rural and social sector obligations. So these are also some of the obligations, because being this Parliament was very particular about it, and that rural and social sector obligations are there, and those will be notified by the IRDA, and I will come to that in the later stage. So the other important act, that is Insurance Act 1938, we have various definitions are there. The definition like any other act. So this the definitions include many things like what is life insurance, what is general insurance company, what is general insurance business, what is fire insurance business, what are the what do you mean by health? All these things are there. So all these are part of the definitions of the definitions have been given. And also one particular thing, if you see that normally foreign direct investments, foreign investment limits are governed in the FEMA Act, and but whereas only insurance sector, it is actually the FDA limits are being given, foreign investment limits are given in Insurance Act. So that's why if you see that many at the time, whenever the act get amended, there would be a lot of discussion as far the FDA foreign investment limits are concerned. Being insurance company being a prudential entities, and as well as the and in historically the foreign investments are governed by Insurance Act only. So therefore, normally there would be it is not so easy to amend the Insurance Act, because a lot of Parliament there is some stakes are involved about the foreign investment and these things. So that's how the FDA limits are also governed here. And with regard to the registration, capital requirements and share transfers, so of course, I mean, as I was telling about it, insurance companies registration is being done by the IRDA, and not only the capital requirements are around 100 crores has been prescribed for the, whether it is life insurance company or general insurance company or standalone health insurance company. But for the reinsurance company, the requirement is 200 CR. So not just the amount is being seen, it is also one moment. So it is in fact the financial condition of the, again it is visible now. Sorry, I mean I moved.
Yes, sir. Visible, sir.
Okay. Yeah. The financial condition of the promoters, and also general character of the management also will be seen. It is not like that whoever brings 100 crores the capital, the insurance license registration will be given. So normally, because the long term, because insurance business itself is the long term business, and initially there would be a lot of capital requirements will be there, and there would be so that's why the financial condition of the promoters is seen thoroughly discussed. After then only the insurance company's license will be given. And as far the share transfers are concerned, it is not like any other corporate where you can simply buy, or otherwise your takeover code is applicable whenever you are triggering this 25% as per the SEBI takeover code. This is something different here. If you are acquiring more than 5% in the insurance company, you need to take approval from the IRDA. Because again, the reasons why statute is talking about is emphasize it is because it should, being a prudential entity, it should be in the hands of the safe hands, and IRDA while giving approval, it takes care about the promoters general character and their background, all those things, and whether they are fit and proper, all these things will be taken care. And even that, if you are actually 1% and above, if you want to transfer, then also you need to take approval of the authority. However, certain exemptions are being given. Being a demat environment, it is very difficult for the listed companies. Certain exemptions are given for to the company, to the shareholders who wants to acquire. That is only listed company, but still beyond 5%, they need to take the approval of the authority. And the account financial statements actual report, these are the something which has been prescribed. And one thing is which is specifically for the insurance company, which is unique, is the shareholders account also should be there, and policyholders account should be bifurcated. There are two types of accounts should be there. One is revenue account, another is shareholders account, profit and loss account. These type of two accounts have been prescribed by the statute. So that's the reason statute itself. So all our prescriptions are as per that. And actual reports have to be submitted. This is again basically the reserves to meet the liabilities of the policies. Because once you take the policy, once the insurance company accept the policy, they keep the money, and it has to, with that money, it has to serve the policies whenever the claim arises, and also meet the maturity claims. So, or death claims, whatever it is. I mean, in the case of life. So these actuarial reports are very key. And there is a specific section is there in this presentation where we'll talk about that what is the importance of actuaries. And investment of assets. Again, this is something, I mean, since there are prudential entities, a lot of insurance assets are involved. And insurance, normally business is long-term business. Insurers are financing the lot of infrastructure projects. So, and there are mandatory requirements are there for life insurance company, minimum 15% they need to put the assets in the infrastructure assets. So they might be less yield making, but they are mandated to do it. And for life insurance companies, at least 50% they need to put it in the government securities, apart from the insurance infrastructure. So central government security 25%, and approved securities are there where even state government securities are there. So there 25% are mandatory. Infrastructure 15% are mandatory. So another 35% is there. There also you can play with the equity, or you can play with the in the sense, I mean, the investments. You can play with, you can invest in the we talk about even debt market, even not ULIPs, whether mutual funds and money market, these type of things which they invest in the out of the assets of the policyholders. So authority has the power to investigate and inspections of the insurance companies. And registration of insurance intermediaries is mandatory. So we have so many intermediaries: corporate agents, insurance brokers, surveyors, insurance marketing firms, PO, point of sale service, and so many are there. So all required to take approval and registration, and the registration is not permanent. It is only 3 years. Every 3 years you need to come for the renewal. Whereas the insurance companies, it was earlier a yearly renewal is there, but now that has been taken out. Now it is a permanent registration as far the insurance companies are concerned. And the dissolution of the insurers, winding up, amalgamation, these have also been covered in the Insurance Act. And we have councils, General Insurance Council and Life Insurance Council. Apart from the Insurance Advisory Council, Advisory Committee, these two councils, they take care of the specific policies pertaining to the life insurance and the general insurance are concerned. And penalties are also prescribed for violation of any violations, basically of Insurance Act. So, and the regulations made thereunder, the penalties may be as high as 25 crores. And there are power to frame regulations. So IRDA is having the power to frame regulations. So the regulations framed thereunder. And of course, there are adjudication, being I am the adjudication officer, certain violations how to be adjudicated, and the adjudicating officer has to recommend, and after taking a personal hearing and everything, submissions, written submissions, and authority may consider the recommendations, and they may levy penalties. So these are the main thing with regard to Insurance Act 1938. Now let's move to the size of the Indian insurance market. So these statistics as on 31 March 2025. You see that is India is the 10th largest insurance market, and we are expecting that by 6th largest by the year 2032. So and of course, I mean, India being the fastest growing economy, obviously the insurance market has to support. So is one of the fastest growing market in the world. The premium income, if you talk about that, this is $138 billion, and in rupee terms, it is 11 lakh crores, by near to 12 lakh crores is the premium. And most of the things as accounted for, the 75% is accounted by the life insurers, whereas non-life is around 25%. And if you see that the claims paid during the last year, this premium figures are pertaining to the last year, 24-25. So total claims paid are around 8,18,753 crores. So again, life insurance is works out the measure, because that includes our maturity claims, surrenders, as well as the death claims. So these are all life will be more, and of course, I mean, non-life, the entire the health claims are quite higher. So total AUM is around 75 lakh crores, and most of the uh, equity equity is actually, if at all it in the traditional forms like par and non-par, they are actually valued at the book value. So the market value is much larger. It might be another, you need to add another 10 to 15 lakh crores. So the major milestones in insurance industry, I mean, I'm talking about last decade. So the amendments 2015 has been happened, and at that point of time, the foreign direct investments have increased from the foreign investment rather, so 26% to 49%. And in 2019 for intermediaries, it is actually 100% FDI has been made in 2019, and 2022. This is the foreign investment limits have increased to 74%. Now, I mean, the 24, there are, as I told, there are a lot of regulatory reforms have been taken place, and those I will come across, I will cover in the later slides. So this is the trends of insurance penetration in India. I hope you are seeing the same slide.
Yes, sir. Yes, sir.
Okay, thank you. See, the trends of insurance penetration in India, basically, if you see that the total the penetration is actually measured as a percentage of the GDP, premium toward the GDP. So it is we have reached to the peak in 4.2. It was in COVID time, because at that point the GDP was also growth rate was very lesser, and as for the insurance concerned, insurance growth rate was stable. And now we are at 3.7. The life is around 2.7, and as far as the this non-life is concerned, it is 1. So it is the percentage of insurance premium to GDP. We'll just see that the comparing with the insurance penetration with other economies, we see that this is the I mean, if you see that India is here. So we have a lot of scope to grow, because normally the developed countries, I mean, it is insurance always is seen that it is not seen as a necessity. I mean, by the people. That's why we'll see that when the movement, the economy grows, the more and more awareness and requirement to buy the insurance comes. So that's why if you see that the countries like USA, South Africa, UK, France, all, if you see that all are developed countries, they are having a huge, I mean, the insurance penetration more than 10. So we are actually catching up, and we hope, I mean, it may not be 10-12%, probably IRDA might be targeting around 6%. So if you reach that milestone, it is nothing like it, and it is very good. In fact, in the next decade, if we are able to reach 10, it is very good progress. One moment, I think I lost somewhere. Are you able to see the trends of insurance density in India?
No, sir. PPT is not visible, sir.
Okay, fine. Let me actually, I think, just let me. Is it visible now?
Yes. Now it is coming.
Okay, thank you. Yeah. So the other important parameter which has been counted is trends of insurance density in India. So if you see that the density is actually calculated as the ratio of premium to the population. So this is actually covered as per the US dollars are concerned. So $97 now we are at $97, $72 for the life and $25 as far as the non-life is concerned. So these two are the parameters which you need to identify, which you need to remember. Insurance penetration, insurance density. So penetration is premium to GDP, insurance density is premium to population. Again, the comparison of the insurance industry with other economies. So we are very, very far if you see that. So USA almost $10,000. We are nothing. I mean, we are $97. So that's the reason, because there is a lot of population and there is a growing. India is, of course, and the economy is going in a faster place. There is a huge opportunity as far as the insurance market is concerned, and it is going to expand like very rapidly, and what we have seen in the other markets. So this is going to rapidly change the ecosystem as far as the insurance is concerned in India. So there are, if you see that insurance ecosystem, total as on date, we have 74 companies are there. 74 insurance companies are there. Out of that, 26 life insurance companies, and the recent one is Go Digit Life Insurance Company, and the giant LIC, Life Insurance Corporation of India. Only one peculiar thing is LIC, the policies of LIC as per the Act is concerned, they are guaranteed by the government. So the claims are guaranteed by the government. Still, that protection is there as per the LIC is concerned. So whereas the non-life is concerned, we have around 27 non-life insurance companies are there, and including 4 public sector companies, and we have 2 companies specialized, that is ECGC is there, and Agricultural Insurance Corporation is there. So these are 2 are also covered under non-life insurance companies. And we have 2 reinsurance companies are there. One is General Insurance Corporation, and very recently the license was issued to the Valuatex. So that is the promoters of Go Digit actually got it. So that is also, and we have 7 Sahi companies. It is standalone health insurance companies we call. So there are 7 companies are there. Apart from that, there are 12 this FRBs, foreign reinsurance branches. They are there. So the 12 plus 1 is Lloyd's, that is foreign reinsurance branches, that is having a different structure altogether. So the input particularly this is 74 companies, and 7 insurers entered in the market in the last 2 years. So we have lot of distribution points, almost 55 crores, around 55 lakhs, 55 lakh agent force are there. Majorly health insurance and life insurance agents are there. And we have 950 brokers are there and 660 corporate agents. Most of the banks are corporate agents, and we have huge POSPs are there, point of salesperson. So, and we have web aggregators like most of you heard about Policy Bazaar. We have more policy web aggregators are there, and the councils, J Council, Life Insurance Council, and health companies are also part of J Council. And we have research and academic institutes. This is NIA Pune, National Insurance Agency. Sorry, National Insurance Agency, I think. Yeah. IARM, this is being promoted by Hyderabad, IRDA, and Insurance Institute of India. It is promoted by public sector insurance companies, and Insurance Information Bureau. This is also promoted by the IRDA, and insurance companies are required to submit their reports pertaining to business. And IAB is actually a data warehouse, and they publish various research reports out of the information submitted by the insurance companies. So broadly, this is more or less which I covered in the earlier slide. That is the insurance ecosystem, and some of the things, new things are there as far as the insurance ombudsman are concerned. So we have insurance ombudsman. They comes under the insurance ombudsman rules. In fact, there we have around 18 ombudsmen which are across various cities. And the ombudsman actually can give a this award up to 50 lakhs. Earlier it was 30 lakhs. And if at all ombudsman award is there, insurance companies do not have any choice to, they need to implement it unless it is being challenged. So as per the ombudsman are concerned, and we have other intermediaries which we were talking about. Some of the intermediaries, third-party administrators. So they are the health insurance is being delivered through third-party administrators, and there are other like healthcare service providers that actually, I mean, hospital, they are not regulated, but they are also in the ecosystem. So just I will give you a glance of risk takers and pass-through vehicles, how insurance business is different from the other types of businesses in the financial sector. So the banks, insurance companies, and NBFCs, these three are the risk takers. I mean, as far as at least, I mean, for the sake of giving an examples, because whether irrespective of their assets performance, they need to meet their liabilities. So like banks have to meet the liability of the depositors, insurance companies have to meet the liabilities of the policyholders, irrespective whether claims are more, less, or whatever it is. Then we'll ask if the such type of situation is there. They need to maintain solvency margin of 1.5 times of the actual calculation of the liabilities. So if they are unable to maintain, IRDA can initiate the action for even winding up also. Normally, since the promoters are being with the full good financial background only taken, so we advise the promoters to induct the infuse the capital, and even for the listed companies also, now up to 25% the capital the promoters have to compulsorily hold it. So that's how it is. Where you talk about the pass-through vehicles, so pass-through vehicles like asset management companies like mutual funds, stock brokers, insurance intermediaries, this alternative investment funds, REITs, InvITs, these pension, these are all only pass-through vehicles. Actually, they charge a fee for the assets that they are managed. So the performance of their schemes and everything, whatever the investment option opted by the beneficiaries, they only have to pay. But whereas the risk takers is something different. That is basically insurance companies fall in the risk takers bucket. So that is the reason it is treated as a prudential entity. So prudential requirement like appointment of CEO, appointment of permission to give branches, products approval, all these things normally lies with the regulators. That's how globally also, that's how it is. So like I'll just compare with the bank and the insurance. So both deal with the uncertainty because the liabilities when in case of banks, actually when you give the loans. Obviously, whether he is going to repay or not, all these things. Like insurance company, when you underwrite a policy, whether when the liability can come. Today you take the premium, tomorrow also it may hit your books. So absolutely there is uncertainty is there. Banker and customer normally may start to medium term, whereas the insurance company, it is for life insurance. Normally it is longer time. It is 15 to 20 years. Sometimes it may be for the life. Whereas non-life, it is normally yearly renewable contracts, like whether it is fire, motor, health, this crop, whatever it is, they are normally 1 yearly renewable contracts. So in case of stability is concerned, anchors, the depositors can ask money at any point of time. Though, so that normally that's why banks normally maintain a lot of amounts to meet the requirements in case of any emergencies. Whereas insurance companies, it is not so easy to get back the money from the insurance company, because the surrender value is normally discourages the, even if something goes wrong with the insurance company. So surrender values are so less. So normally there would not be, you will not see any run on the insurance companies. As far as that's why they actually invest more on the long-term investments, like insurance infrastructure financing in all, even in the developed countries, and the lot of funds funnel through insurance sector. So, however, the normally insurance companies, the fall of insurance companies will be a slow process. It would be like a horizon of 3 to 5 years. Then only we'll come to know whether the insurance company is actually doing well or what. I mean, how it was going, or going to go into, I mean, wind up mode. So this is something, insurance for all by 2047. This is the vision of the IRDA, and in the recent past it has been adopted. The thing is, every citizen has an appropriate life, health, and property insurance cover by 2047. It resonates with the 2047. I mean, India's vision of 2047. So, and the 3 years is something which we are actually targeting. That is availability, accessibility, and affordability. So, the insurance product should be available whenever you want, and it is a product should be accessible. And also affordability. Also, products should be affordable. It's not like that products are available with, but however, people cannot afford the premiums. So these 3 years are the target for the IRDA, which has taken as a vision point. So to achieve this, we require more players in the market, and in that, I mean, at least it was thought about that at least 200 insurance players we require by 2047, and we also use digital footprints should be there for distribution of the insurance intermediate distribution of insurance products. And more capital is required. A lot of capital requirements are there, because being a long-term investment, that's why foreign direct investments 100% is also thought about it. And more coverage to all parts of India, whether it is I mean, whether it is developed parts or underdeveloped parts, northeastern parts, wherever it is. I mean, the more to cover every part and nook and corner of the country. And more underwriting expertise will come if you are having large numbers. Insurance is nothing but a law of large numbers. More numbers will come, obviously the premiums will go down. So, and that's how it actually works. So these are some of the recent regulatory reforms which have been taken place. And since there are many reforms are there, so I actually try to put it in the different buckets. Some of the, as I was telling about that, principle-based regulations, we moved from the rule-based regulation to principle-based regulations, and that's how. I mean, many things have been been given to the insurance companies, like some of the operational flexibility which are talking about the insurance companies. Right now, the earlier it was file and use. All products should be filed first, and after examination they can be used, and once the approval is given. Now, except some of the products like savings products, insurance company saving products, most of the products are now use and file. I mean, just now they give the information to the IRDA, so the approvals are not required, and they can actually launch the products immediately, as per the market requirements are concerned. And we also earlier the capital requirements. I mean, whenever they raise the capital through debt, other forms of capital, especially they rise through this preference shares or even debt instruments, they need to take approval. Now that those are taken out, now it is not required. And for opening of the branches, as far as they are meeting the expenses of management requirements, then no need the insurance companies to take approval from the authority for opening of the branches for expansion. And expenses of management is something which is a major changes are there. Earlier lines of business, each line of business is having expenses of management requirements are there. Expenses percentage of the premium. However, now overall expenditure limits have been prescribed. Some sections like in life insurance, some like annuities are having separate limits, but otherwise it's single policies are having separate limits. Now it is more or less it is the more flexibility has been given to the insurance companies. And the commissions earlier were also the limits were prescribed. Now commissions actually subsumed within the expenses of management limits. So in the non-life side, where 30% is the expense of management limit, and as per the insurance, health insurance is concerned, it is 35% of the premium earned. So I mean, we all know that the insurance is normally, I mean, it's a push product. So the persons, as I initially I was telling, the persons who wants to take the insurance, probably insurance companies may not give it to them because considering their actual experience or claim experience is concerned. Like, I mean, I give an example: if somebody wants to take policy at years of 70, they may not like to give because the risk is quite higher and the premium is unaffordable. But the person is at 20, insurance company wants to offer, but the person may not be having any interest because he doesn't see that any risk in his life unless any life risk is concerned. So that's why this the mostly the commission rates and the expense of management, and that includes management and commission. All these are covered on the expense of management are concerned. And we also having some of the major things are as far as the policyholder empowerment is concerned. Many things have been changed, and I mean the policyholders now empowered to many ways. Some of the things I just bring it out notice. That is like citizen charters they need to publish on service standards, and we talk about that the suitability of the product has to be seen. Except some of the products like when you are taking annuities from the NPS amount that you are transferring, or some of the term policies. Otherwise, most of the life policies are required to see that suitability analysis. And a pre-look period has given to 30 days. It was earlier 15 days only. Customer information sheet has been introduced in all lines of the products, whether life, non-life, health, and there it is customer information sheet, which is in a easy language. One can understand what is the covered, what is the how to make a claim, what all the things are excluded. All these things are covered in the customer information sheet. If you see that in our policy, you can definitely find that. And some major improvements as far as the health is concerned, it is all types of treatment should be covered, whether it is homeopathy, allopathy, or Ayurveda. This type of treatment should be covered by the products. And maybe, I mean, they may charge a premium, but the policy should be available. And all ages should be covered. Even now, health, the mandate is, even somebody wants to take at 80 years health insurance policy, it should cover. Maybe that again, that all depends upon the premium which they charge. Only thing is, earlier it was 65 years was the mandatory. Now it is you need to give to anyone. Only the premium is as per the claim experience, as per the actual calculations of the insurance companies concerned. So again, there are 60 months moratorium. Earlier it was 80 years. I mean, now it is reduced to 5 years. So after 5 years, a policy cannot be questioned unless it is issued in the some fraud has been occurred while taking the policy. So these are some of the things, and even I mean, for Ombudsman Award, if it is not being implemented, around 5,000 rupees penalty is leviable per day. So these are some of the things got introduced, and we also see that I mean the distribution is concerned. There are almost Now earlier the main corporate agents who are now all banks are corporate agents. So now they can actually distribute up companies of 9 life insurers, 9 non-life insurers, almost like a broker only. 9 health insurance companies. So 27 types they can have, so that I mean they can meet the requirements of their customers for cross selling. And the governance is concerned, that is also got strengthened a lot. Now at least 3 minimum independent directors should be there, and the mandatory committees like risk management committee, audit committee, policyholders committee, clients monitoring committee, NRC, CSR, grievance redressal. There are some of the thing, ALM. All these are committees are required as per the governance, corporate governance is concerned. And we have this insurance inclusion. So there are rural and social sector obligations, and it is motor third party obligations which are authority has to prescribe that. So those in that now a lot of revamp has been made. Earlier motor third party, even for the new vehicles, are also covered under that motor third party obligation, because normally motor third party are treated. Insurance companies think that motor third party have a long tail for the as far as the claims are concerned, because there are normally the claims are settled longer, not even 1 year or 2 years, it may be more than 3 years. So so they may go to the they are covered under Motor Vehicles Act. So it takes longer time. They have the long tail. That's why motor third party generally insurance companies try to avoid. So if you mandated that they cannot avoid, and at the same time the requirement is motor third party. Now they need to do the vehicles which are not covered earlier. So those type of things, applications have been given. Rural and social sector now. I mean the insurance companies are given some. There is a state insurance plan. I've been assigned, all insurance companies have been assigned different states, so that I mean they can concentrate and they can basically they can develop promote the insurance business. And they have been allotted some gram panchayats, and that gram panchayats they need to bring the saturation level. So whether it is life, non-life, and different types of products are there. So these are some of the major things which have been taken place, so that the 3 A's, which accessibility, availability, affordability, can be achieved. And by 2047, all insurance, all citizens of the India are covered under insurance and are having the insurance accessibility. So these are some things like regulatory framework for ease of doing business. Some 57 regulations, 2000 circulars all been consolidated and now brought down to 10 regulations, and master circulars have been introduced. And there are another, even we talk about regulatory returns also have been revamped, and we now thinking about even the intermediate regulations are also to consolidate, and in fact the team is working on it. And these are some of the future requirements for the insurance industry to compete with the come to the global standards. Risk-based supervision framework. So this is something rather than using the same stick for the same type of company. Like I mean, like we compare with the newly the regulations are earlier, the regulations even now also the rules and regulations are one and same for the say the company like LIC and the company like Go Digit Life, which has got recent registration. So it's why the risk based, because which is actually the too big to fail. This type of things, and then we have some of the companies like FinCons are there, financial conglomerates. In fact, and BFSI sector, there are around 12 FinCons are there. IRDA is the leading regulator for 4 FinCons, and we also have that's the reason this type of things like risk-based supervision is going to talk about that more, not more toward the compliance, is more toward the risk. That type of framework we are contemplating. And IFRS implementation. This is accounting standards this from 2022. All global insurance regulators have mandated to move to the IFRS, and some of the jurisdictions are moving toward that. And India, we also have mandated to the insurance companies, and they started filing the provisional IFRS compliant figures. And by 2026, we are going to have a first set of IFRS compliant this financial reporting. Risk-based capital, again, now what I was telling is 1.5 times of the actual liabilities. This risk-based capital is a different regime. It and this may actually some of the companies may require to put more capital. Some of the companies may release their capital. So RBC is also we have come out with the two types of the two policy statements. Framework for the second framework has also come as per the RBC is concerned, and that is one thing which is in the pipeline. And some of the insurtech, these things are there. Basically, whether it is RegTech, SupTech, this type of technology innovation, because so that IRDA and as far the insurance industry is concerned, it is future ready for the new challenges. And this is the Bima stack which was talking about. So this is the basically the Bima Sugam. You would have seen in the recent newspapers. All insurance companies have actually started this Bima Sugam, and they promoted this with a 300 crores capital, and it would be like one-stop solution for the insurance company insurance requirements. And this is something which recently our chairman has inaugurated, and they are going to come out with the and this is the one-stop solution for all companies can participate, all intermediaries can participate in this Bima Sugam. We do have Bima Vistar product which is in the pipeline, and which we want to have some parametric type of products. Basically, rather than investigating, it is basically the claim processing should be easier. And we have Bima Vahak, women-centric products which we want to initiate. That is, Bima Vahaks are going to sell that products. That Bima Vistar product is going to be sold by primarily by the Bima Vahak. So these are some of the amendments which are proposed in the Insurance Act 1938. I'm actually giving this information based on the media reports only, or whatever is the published information. So basically, there was talk about that captive insurers. So some company, if they want to have say big conglomerate is there, big corporate is there, like you can name it from like Tata's, Reliance. They want to have any captive insurance, they can themselves can have which can cover the insurance requirements of their own company. All these type of things they do have. That is it is actually very famous in the foreign markets. So, and also we are thinking about regional players which are less capital, and of course, giving insurance companies can provide the value added services which are incidental to the insurance business. These are some of the things which are thought about it. So, and the capital requirements may have, now it is actually hard coded in the Insurance Act. Now could be the requirements as per the if you talk about banks, there could be small banks will be there, small finance banks are there, normal universal banks are there, and this type of things, RBI regional players are there. So like that, this type of things may come in the insurance sector. Now it is a universal license. Once you are issued and they are required to operate in across India, so they have the license to acquire, but they may not reach to all parts of India. Maybe some may be interested to do in only one particular region. So that's why this type of things, flexibility is expected. So and also IRDA, empowering IRDA to give regulations. And right now there are many of the things which are hard coded in the Insurance Act that may be that powers will be given to the IRDA. Now amalgamation of insurance companies with a non-insurance company is not permitted. So that also we are actually contemplating, and perpetual registration for the insurance intermediaries is contemplated. And penalties now, some penalties are hard coded that you need to, by violation, you need to charge this much. So some flexibility might be required, because considering the size of the entity, the penalty may be differ. So, I mean, like individual surveyor and a company like LIC, you can't put the same penalty. So that's the reason some flexibility is being thought about it. So these changes are normally are expected in the insurance bill, Insurance Act amendment. Now I just cover some of the flagship insurance schemes, which are actually these are insurance schemes which are promoted by the government and with the alliance of the insurance companies. And some schemes are not with even trust mode also, like PMJJBY, Prime Minister Jeevan Jyoti Bima Yojana. So basically, this right now they charge around a premium of 436 rupees and a coverage of 2 lakh, and almost I mean around 24 crore people are covered under that, and there are almost 10 lakh claims have been paid till date. Prime Minister Suraksha Bima Yojana. This also, I mean, most of these schemes are administered through banks. So the SBI, and there 20 rupees is charged per person, and because since a claim, accidental claim of around 2 lakh rupees is given, almost around 1.6 lakh claims were processed, and almost 51 crore people population are covered under PMSBY. And we have PMFBY, Prime Minister Fasal Bima Yojana. This is for I mean, this started for the crops, and this also normally, while distribution of the loans, the insurance premium can be opted by the farmers. And if you talk about it, there are almost I mean the premiums ranging from 1.5% to 5%. That is based on Rabi or even Kharif or this commercial crops. So around 2 lakh crore claims till date have been processed, paid, and mostly these are the claims are being paid not by the survey. Survey will also be there. There is weightage will be there, but mostly these are parametric. So in a particular region, there is some calamity has occurred, and if they say that this particular area has been affected, or there is a less rain than they expected. So in that area, whoever has been registered, the amount will directly go into their account. There's no need to claim. So if there are local calamities, then there would be, then they need to talk about it. Otherwise, these are a parametric type of insurance products. And we have a PMJAY, Prime Minister Jana Arogya Yojana. So this is one of the very popular product. Almost 55 crore population. 1/3 of the population is covered under this PMJAY by the in this scheme. So around 5 lakhs is being the this limit insurance claim is there. No pre-existing diseases or no pre-existing diseases are being all pre-existing diseases are covered under that. And actually they no need to give any premium. Insurance premium entire being paid by the government only. So I mean there is a state government and central government partnership is there. How much they need to, state government has to give, how much central government will give, and there are almost some of the states administered through trust, and most of the states administered through insurance companies. So insurance companies, wherever insurance companies are there, so the premium they quote for the premium in wherever the region is concerned. So they are eligible for the L1, then the contract will be given to them. But all the rates, all procedures and everything, hospitals, everything administered by the National Health Authority, NHA. So they actually, there are almost around 2,000 procedures have been given. I mean, the recent past, if you've seen that last week, the rates have been increased. So there is a spike in the insurance companies' stocks also. So almost around 31,000 hospitals are there, which are covered under that. So this is one of the major scheme, successful scheme run by the government. So now I just cover the almost insurance business is concerned, and now I just move to the one particular sector. I mean, how a life insurance company statements which are different from the other financial statements. I mean, since it's specific to life insurance, even non-life is also there, but very peculiar to life insurance. That's the reason I try to highlight, being all our my professional colleagues are accountants, so that might be interested to see this. So they are covered under the actual finance and investment regulations 2024. So, and the cash flow statements must be in the direct method, and it is given mandated and given in the regulations itself. So the some segmental reporting is compulsory, and there are various line items how to be reported are also given and in our regulations. So the revenue account, that is technical account we call it as, and there is a policyholder and the other names are technical account, policyholders account, and whereas the P&L account, profit and loss account, is called the non-technical account and shareholders account. See, whatever the surplus is there in the revenue account is moved to the shareholders account, apart from the actual reserves are concerned. So actual reserves, that will be over and above actual reserve, the final amount will be transferred to the shareholder funds. After meeting the shareholder fund expenditure, the amount will move to the balance sheets. So balance sheets, and there are around various 16 schedules have been prescribed under the balance sheets. So some of the specific line items, like these are to be certified and determined by the appointed actuary. The role of the auditors is very much limited as far the liabilities are concerned. Very much limited, because the entire figures are being calculated. The policy level calculations have been done, and they take various assumptions and the while varying the liabilities, and after then the accountants, like chartered accountant or the professional colleagues, so they need to certify only based on the certification of the appointed actuary, so that they have to take back to back. And the change in valuation ability also, this is one thing which item which will come in the revenue account. After then only the surplus will be moved to the shareholders account. So appointed actuary, normally they consider these are the main things, like what is the claim experience of the insurance company. I'm sorry. So the lapsation and surrender experience, these also will be taken into consideration. Interest rate change, because see, you are locking your liability. Considering that, I mean, say suppose that you are taking a savings policy, and your most of the 10 benefits are fixed. How much you are going to get, all these things. So and I'm talking about non-par. Par is something. Par products are normally, it is a participation in the profits of the insurance company. Non-par is concerned, normally it is the defined benefits only you will get. So when you are paying the first premium itself, your return for the next 15 years premium is being decided now itself. So that's why a lot of calculations are involved while deciding the interest rate, because they need to take. That's why they hedge their portfolios in the financial derivatives and the interest rate features also they do. So a lot of, big players as far the insurance companies are concerned, the interest rate derivatives are being used by the insurance companies, and they are the buy side. And normally banks and you talk about the banks are the opposite side of the contracts. And the mortality rates, these are some of the things has to be taken into consideration. Expenses change and rate of inflation, all these factors have to be considered by the appointed actuary, and the liabilities figures are being estimated accordingly. The reserves of we talk about actual reserves have been calculated. Some of the specific line items which may have impact on the valuation, like I was talking about amortized cost of the debt securities. So this is and the provisions for NPS. This is all again. NPS. The provision norms are as per the IRDA follows the provision norms as per the what has been prescribed by the RBI to the banks. It is normally it is same across. Across the financial regulators. So the NPAs have to be. If you see that yesterday also there is some working paper has come as far the RBI is concerned. It's on the provision of expected credit losses and impairment of the investments. This impairment has to be taken, and that has to be considered. And valuation of investment property. insurance companies are permitted to value their investment properties once in 3 years. So that has been taken into revaluation reserve, and that revaluation reserve has to be kept. I mean, whenever there is a when the asset is being sold, that revaluation reserve can be used for the purpose of distribution of uh, bonus to the policyholders. So otherwise they can take permission and they can do, but that is very exceptional, and IRD never gives that permission for such type of things. Fixed assets are valued at the historical cost. If you see that some of the public sector companies, they have all the fixed assets located at across various places. Though, I mean, just giving an example, giving that, I mean, now the companies like this National, United or Oriental, they have the net worth is not up to the mark and their solvency ratio is below the prescribed 1.5, but still they have a lot of value unlocked in the investments, because the investments are valued at the cost, and especially shares. And as far the fixed assets are concerned, they are all valued at the historical cost. That's the reason still it is being, I mean, the companies are able to survive. And the changes in the fair value change, this is something fair value change, again, the appointed actually does that. As far the ULIP investments are concerned, they are all mark to market. ULIP investments, the investments are also can be made where daily the price has to be there, then only they can buy it. So that's why ULIPs investments are valued market to market value. So once the implementation of the IFRS is concerned, so I was telling you that this 2026 we see the first phase of companies who are going to implement the IFRS. So there could be sea changes as far the reporting is concerned. Now the entire premium is taken as the income now, right now. Tomorrow, I mean, once the IFRS is taken, it is only contract service margin, because there is a savings margin is there, and there is a future liabilities are there. All these are being considered in the premium, right? So that the contract service margin is being calculated for each cohorts of the policies. It is mostly affect the life insurers and long-term contracts. So all cohorts will be taken, and there will be the type of product will be taken, and the contract service margin is being calculated. That will be shown as the, and that from that margin only you will release the amount will be released as the income. So there will be sea change, and in the as per the after IFRS 17 is implemented, and there are expected credit losses for investments, as I was telling about that RBI just came out with a paper. So these are for the investment sake, these are expected credit losses are going to come. Now the investments right now are valued at the cost and amortized cost. Now they need to consider the expected credit losses. Especially this will affect the debt and securities are concerned. And loss making contracts, they need to upfront provide the provision. So the appointed as per the actual calculation, if they feel that the particular contracts are going to fetch are going to make losses, they need to provide immediately. So that's why and now what we're going to see it would be now the financial statements are now expected, because premium we know that, I mean, certainly this is the amount. Now tomorrow once the IFRS is implemented, it is all many of the things are depends upon the estimates and assumptions. So this could be a sea change which you are going to see as far the insurance companies financials are concerned. And the valuation of investment properties, this also is there, and there would be significant impact on the valuation of assets and valuation of liabilities are concerned. So this I mean, being accounting professionals, we need to, there could be, I mean, we can take a separate session if it is possible, if the ICMA permits. And this actually IFRS implementation and expected credit loss, how it is going to take complete CISA changes, we may actually talk about later. But otherwise, since many of you are practitioners, though IFRS is going to change many of the assumptions based financial statements are going to come. So with this, these opinions or views are expressed in my personal. So nothing to do with my employer. This is only for the information purpose. So that's what I would like to, and I would like to take uh, any questions, if at all any are there. So
Thank you, sir. Thank you for your exhaustive presentation. Uh,
thank you
Sir,
very
a
much.
few
Thank you very much.
questions have come in our chat box. I think one of the first question is that why banks are reinsured with foreign banks? One question has come. Sir, if you can answer that, sir.
It is not foreign banks are reinsured. Basically, any asset, any this thing, any person who are in India has to get coverage only from the Indian companies only. I mean, you talk about foreign national; those are different, and they need to take the and assets are except some ships are there, so they need to are aeroplanes. The any other, if you are taking coverage from the other outside India, they need to take permission from India authority. Very few exceptions have been given, but what is being taken is insurance companies, once they underwrite the products, once underwrite the policies, then they can actually place the business reinsurance, because see, they are the they may not keep the entire risk with them. The reinsurance business works that, say, suppose you're taking a 100 rupees policy, 100 rupees premium, they may think that, I mean, the some, at least they will retain, say, 20 rupees, and 80 rupees may actually give it to the reinsurer. That reinsurer, there is a mandatory reinsurance premium has to be ceded to the GAC, General Insurance Corporation. That is, as per the every year, the notification comes. 4% has to be given to the GAC, and later there are certain order of preference has been given by the authority in the reinsurance regulations. First, it will go to the Indian reinsurers after GAC. That is, value ethics has come. Later, it will come to the foreign reinsurance branches, which are registered with the authority. That is, around 12 foreign reinsurance branches are there. Like if you, latest the Swiss Re, Munich Re, and we have AXA. This type of foreign reinsurance branches, they actually reinsure these risks. And after then, if they want to go about to outside India, they can go to the cross-border reinsurers. They are around, they also authority recognizes around 300 cross-border reinsurance are there. So they can place some of the business there. So this is the actually order of premises. It's not like that they can directly take the insurance policy from outside India. I hope I have answered the question.
Yes, sir. Sir, another question has come you in your presentation also you mentioned the various policies like endowment policies, which is presently a lion's share of insurance, and previously tax regime was such that we used to get tax exemption under 80C and other sections. So now with the new tax regime, we don't have any such benefit. So do you feel that this insurance habit, which has been inculcated maybe through tax savings as an incentive, will take a beating with the new tax regime, and maybe the insurance for all goal of the government of India may be impacted with this? I think maybe premiums will not be paid, or maybe policy would be closed down because of this no benefit the policy holders are getting as per the present regime. What is your feeling and your opinion about that, sir?
See, as per the life insurance concerned, and it is rightly pointed out that traditionally life insurance is being treated as the savings product, as well as the mortality risk is being covered. Many few people normally take their whole term, whole term insurance. So pure risk coverage. But I mean, of course, nowadays there is a people are actually are moving toward the more term insurance, so that they can plan. But still there are apparent advantages as per the insurance life insurance contracts are concerned. Say still the one is 80C is there as per the old regime is concerned. The even the claims, whether death claim or maturity claim, if it is more than 10 years, it is actually tax free. So this and even insurance companies are also giving nowadays that staggered maturity claims. So they are not giving it like a systematic withdrawal plan type. So it is not going to affect, because see, I was telling that we are a lot, I mean, hardly we are a percentage of 2.7 as far as the life insurance is concerned, insurance penetration. A lot of long pie is there, lot of pie is there. And during the, I mean, the growth stage of the economy, obviously the requirements are going to increase, and we are going to see more requirement of the insurance, more, I mean, growth in the insurance is sector is concerned.
Right, sir. Sir, presently, banks are not allowed to do insurance business under the same company or balance sheet. What is your opinion? Why? Because both the banks and insurance are very much correlated, and objective is same, to give services to the our citizens or the investors or customers.
See, banking, if we talk about Banking Regulation Act, it Section 6 of the Banking Regulation talks about that what are the things that they can do. So because they are the prudential entity, because there is a what banks can do is actually given 1, 2, 3 things. It can't go beyond. Like insurance companies, it talks about, the Insurance Act talks about insurance company what to do. It can't go beyond whatever it is. Being a prudential entity is not everywhere in the world. So super tomorrow some manufacturing companies comes and wants to do the insurance business, you will not give the business. They have to be a separate entity, and that separate entity should have the capital assigned to that, and it is everything. You can't actually commingle everything. So it is a absolutely we can't actually, that type of scenario cannot come in future also. Under I mean Banking Regulation Act, the subsidiaries they can take, and that's how the insurance companies have been promoted to the banks. And being the distribution muscle, obviously banks have actually minted money by becoming a stakeholders, and as far as the distribution fee-based income is concerned.
Right, sir. Sir, IFRS 17, you have touched that it would be implemented very soon.
Yes.
Sir, any country which has actually implemented this IFRS 17 as per your knowledge goes, sir?
Some of the countries like I think Singapore has implemented, Hong Kong has implemented, some of the Western countries. See, there is implementation everywhere. The little bit one thing is technical knowledge is concerned, because all policies and a lot of system changes have to be changed. System changes have to be made. Because earlier it was a estimation is been done, though the estimation is done, now it is to be shown, and the accountant role is more. Now earlier I was telling about that accountant actually gives the certification which will be taken by the this auditor. But right now it's a lot of mix has happened with the audit and actuarial is concerned, and the systems are not geared up. Software is also not there in the world over. And there could be also effect on the I mean the capital requirements and solvency requirements. So many countries are going slow, though I mean there's aspiration that IRDA is going to implement this IFRS next year. So we let us see.
Sir, now the most important for a cost accountant, sir. Sir, you must be being a CMA. You know the role of CMAs are paramount in insurance sector. And as far as an official of the IRDA, what do you think our institute can be a part of this insurance advisory committee, so that we can place our representations and our mandate of equal opportunity with other professionals, and for various professional pursuits we can do or venture for the interest of the nation. So what is your thought process, sir?
See, I'll just cover some of the opportunities as far as the CMAs are concerned. See, there are many certifications required as per the intermediaries are concerned. So whether capital, these type of things are the many requirements, compliance requirements are there. And also as a surveyors, CMAs CMA chartered accountant CMAs are only eligible candidates who can participate in the loss of profit surveyors. I don't know, many might be knowing it. you can clear the examination, you can become that surveyor, loss of profits surveyor. So that is one thing. And with regard to other opportunities are concerned, like representation in the IAC, or even we also thinking about, in fact, because see, the health insurance, if we talk about, major part of premium, major in the sense, it's more than the premium, claims are being paid now. So and we are all the other thing like expenses of management. So we are actually being a cost accountants. We are more into the how to reduce the reduction of the cost, and how to make this thing. So there could be good areas of scope where practice can be made, and advisory can be given, and so the claim experience, claim expenditure can be curtailed. So we hope, there could be some, and also the intermediaries. I was telling about a huge number of intermediaries are there. Probably some type of outsourcing, because authority now we are having offices at only at Hyderabad, and we are maximum we are going to have at Delhi or Bombay. So we can't have all the offices across India. Maybe these type of things we can really may come in the future. That's my my expectation. I have nothing to do with my any professional knowledge.
Thank you, sir. Sir, one technical question. Sir, earlier embedded value of life insurer was mandated to be at least 2 times of paid up capital. So presently, why applicability of IFRS is getting delayed, as now deadline has been extended to financial year 2027?
No. See, embedded value is not actually, we never told that 2 times or anything. That is something which normally markets actually talk about that. We are only told that it should be part of your public disclosures, especially for the listed companies. They need to give the embedded value in their annual reports. But it is not that it is compulsory. Only the solvency requirements has been mentioned, that is 1.5 times. So embedded value, it is more relevant for the life insurance companies. Normally, the price moves. It's a global or otherwise the historical standard as far the Indian capital markets are concerned. Normally, it ranges from 4 to 5 of times of the the market cap is 4 to 5 times of the embedded value. So that is as far the embedded value is concerned. It is only the value will being prepared by the accountant actually, that has to be disclosed in the movements of the embedded value has to be disclosed in the public disclosure as well as the annual reports. I think the other question what we were talking about, I missed out.
Yeah, sir, why applicability of IFRS is getting delayed?
No, that's what I mean. I was just covered, no? That basically one is there are the systems are not ready. There are the persons who knows this, especially the IFRS 17 is more complex. If you see that is the last standard after a lot of from 2004 it is discussed a lot, and finally 2022 only the final standard has come. So, and that also they started implementing from 23. That is the global thing which was actually the mandate was there by the as per the accounting standards board is concerned. So basically, it is actually companies are not geared up, and we are trying to build the capacity. This all IFRS compliant statements that also is being mandated. We have to wait and watch. How it is going to turn out to be.
Thank you, sir. I think many questions are there, but due to paucity of time, because we have already crossed 7, and I know, sir, it's a long day for you, and we do not want to keep you on hold because weekend is coming, and festive season has already started. Today being Karva Chauth also. So we thank wholeheartedly Adankya Ramana Rao sir, who has always been saying yes to our request for webinars. Maybe some approval has to be taken from IRDA, so not every time he can come, but he has made today time, and I am thankful to him. And I think all the participants till the wee hours of today, I think 7:05 now. Please now also people are logged in, and I thank wholeheartedly, sir, for your kind presence. We thank our chairman Seema Chittaranjan Chattopadhyay for always motivating us to organize webinars, especially of in all the three verticals of banking, insurance, and financial services. And we also thank our BFSI board members. Few board members have joined today, and from the chat box we can see Dr. Ashok Jain sir, Balu sir, and maybe one or two senior members like SN Roy sir and other people like Unhelkar sir has joined, and we are very thankful for their kind presence. And we also thank our president, vice president, other council members for always giving us the motivation to organize events on an online forum. We thank our other departments, especially IT and CPD, for getting us the all backup support for organizing this online webinars. We thank our team, especially Shantanu, Roop, and others for supporting us to organize this webinar on an online forum. I think we have not missed anybody, and I hope, sir, in the coming days, BFSI would be organizing more such webinars on the three verticals, especially insurance, which is many of the members are telling we should have more events, more activities, and we take this opportunity to say that we have done a lot of activities on insurance. We have presently certificate course on general insurance with and we also have conducted various months, insurance months, where many of the stalwarts from the insurance sector has joined. And I hope, sir, we would be continuing this work in the coming days also. Thank you, sir. Thank you for your participation.
Thank you very much, Divanji ji. I mean, it's my privilege to be part of this, and I really thank ICMA Institute and even BFSI chairman also, Chittaranjan ji. I think. Thank you very much, sir, for all the best, and wish you happy Diwali in advance. Thank you.
Thank you,
Namaste.
sir. Thank you, sir. Thank you. Thank you, sir.